Aloha and welcome back to Java. Thank you all for joining me. This is for the week, and today is Sunday, November 26, 2023. After Thanksgiving holiday in the United States, the markets were closed Thursday. So I hope that everyone got some time to spend with their family and loved ones. I think that's the most important thing we can do. And anyway, let's get into the markets and what's going on. I've missed you all, so thank you kindly for coming back. Sentiment right now is risk on. The Fed, everyone thinks, is going to pivot. That means not just hold rates, but cut rates. And while they will be eventually buying everything, I think they're going at a slightly slower pace. So let's see what's going on at the moment. Everything green looking forward, but I will go over this more in the morning prior to market open. So my personal opinion, none of this is financial advice. You have to do your own research. But I'd love to help out with a couple of insights here. The $7.6 trillion of US government debt will mature in this next year. So, adding pressure on rates, this is an incredible thing. They can set their own interest rates basically on the debt that they're sitting out through this mechanism with the Federal Reserve. So, until they have to, when they have to restructure this debt, meaning they have to basically reset the rates to the current rates at the time, I think they're going to just hold where they are for a couple of reasons. And there could also be another timing for the rate cuts that they're talking about coming. I think they're going to be later than most people think, unless we hit a solid depression that they cannot deny. We're already in one now. So moving forward to mortgage rates have fallen to 7.29%. So it seems that the volume level, just as if you're looking at any other equity, the volume level where there's buyers is at that magic 7% level. So if it hits 7% or just a little lower, what that does is open affordability to enough buyers that could create a home buying spur and be a boost to the housing, because right now it's dragging terribly, and really it does not have some good support at the moment. So until that happens, the housing market's facing serious headwinds. So they're talking about inflation gauges, just meaning basically inflation is starting to come down so that they won't hike any longer. Well, as I said, what happens is this inflation gauge is, aside from being very precarious, it goes too quickly, dumps people into a depression. So they're trying to smooth it out and not let anybody know that we're really in a depression at the moment. We're well into recession, have been for at least 4 quarters now, and they're not reporting it. So with the other stories, they keep putting these other uh, basically stories out that don't reflect the real economy. So Black Friday sales were record sales, and you'll see this everywhere. $9.8 billion. So it's up 7.5% over last year. 5.3 was in mobile shopping. But the reality is 7.5% only beats inflation by so much. And shoppers are being encouraged to bargain hunt. So basically what happened was retailers understand this is their last chance to basically make money for the year. So what they've done is they gave deeper discounts, more than they normally would have, and they started the shopping season as early as Wednesday. Typically, it's not until Friday, hence the term Black Friday. But they knew this is their last opportunity. So the larger retailers and companies started 24-hour discounts. And so that has kind of buoyed this. And a lot of the spending is also people have been waiting to get these discounts. So a lot of bargain hunting going on. Did you purchase extra things just because this season, because it's strong? Or did you buy because the prices went down? You can let me know. So aside from the Black Friday shoppers, they are saying that there's still excessive savings. So this says Britons, but really it doesn't matter. You could say Americans. It's pretty much across the board that if you still have savings, they're after you. They want your savings out. So once you are completely drained, this is the other target number, I think, that will indicate the rate cuts coming. So, along with government debt, if they have to refinance that debt and they can't find a different way to push it down other than cutting rates for themselves, once the savings shows that it's completely drained and people can't spend any money anymore, so basically showing through a full depression, they will cut rates for certain. But I think between one of these two will determine the timing. So, best November on record did have stock prices continue to rise, closed in the green stock market higher on Friday. So that's 4 weeks in a row, even though it was only marginally. But basically, what's going on is retailers are seeing there's not a better place to put their money and holding on to it. They've got this idea they can make a ton of money in the stock market, so they're basically gambling. So, with this, we are victims of boiling frog syndrome. And the reality is, as I say here, a money supply inflation. So, another part of inflation that's going to happen will be tied in with oil. So, the OPEC Plus meeting was supposed to happen this week, but they put it off until this coming week. So, they're deciding on how much supply they're going to cut in order to boost the price. So if they boost this price, it will be massively inflationary because they need to make money. They need to keep it above the $60 level that they're saying. So how this works basically, for those of you that might be new, it's not about prices rising, really. It's about the value of the dollar. So if they gave everybody $1 billion, everyone was a billionaire all of a sudden, then think about just the price of a house. Same house you would want to buy would all of a sudden become nothing. So you would be willing to pay more for it, and that raises the prices. So, what I want to point out is since only 2018, it's not that long ago, $1.22 today, that rate is on the 4.14% inflation rate. So that means that translates to 22.47% increase. So, unless you have your money getting an investment return, 22.47% over that period, then you're losing money just by doing nothing. So that's just all it takes to basically tread water. So we've got another economic indicator, I think, for the real what's actually going on. Travel. Travel is down tremendously, less than what they had expected. And I put out the survey, and mostly it's younger Americans talking about how they cannot travel home for the holidays. But I think this will be showing pretty soon, probably not until early next year. And one other thing that we've got to watch is there is the quote unquote Santa Claus rally as portfolios are being rebalanced. But there was not long ago, we had the worst Christmas Eve there was, and it went into the Great Recession. So, a couple of updates I want to bring up. C3 AI. So, this is basically artificial intelligence. Wanted to bring this up because we talked about the whole Sam Altman drama. And the board basically let him go. So, he's come back with a new board with funding by Microsoft. Okay. So, Microsoft is backing this. And who is on the board? We talked about this is Larry Summers, who is the ex-Treasury Secretary. Salesforce, which is basically behind all of the businesses, customer relation management. They've got large database there. And then Quora, who is the CEO of basically it's an online questionnaire for people to ask about anything. And the whole reason Sam Altman was reportedly let go in the first place was because they were warned about a breakthrough in artificial intelligence that could potentially threaten humanity. And so they let him be aware of this, and he didn't want to take action. So there was some type of disagreement there, and that's where all that happened. But now he's back with a larger board and money backing. That concerns me. I know that's not a popular view. Everyone loves him. But anyway, just some food for thought. And I'd like to leave you off with the last thing. Can money buy happiness? So, and I want to ask you this. So, what they came out saying is baby boomers set a net worth below $1 million, they would be happy. Gen Xers, the number is 1.2 million. And for millennials, they're saying 1.7 million. So my question is this. Do you think that this disparity is due to them expecting prices to be higher? They want the same things, but they know the price will be increased? Or do you think it's because they want more things and they're entitled more? And basically, we all know that nobody wants to work. But aside from that, the purchasing power, why do you think the disparity? Let me know in the comments. I'd love to hear from you. Other than that, I wish you all a great day and see you in the morning before the markets. Thank you all kindly. And until I see you then, stay free.